All right, welcome back. This is module 4 of the speed banking class. In this module, we're going to be talking about the difference between lines versus loans. And this is just the basics between lines versus loans, because in future modules, we're going to be diving deeper into some of the differences between the two, how the interest works, all of that stuff. But this is kind of at a high level of lines versus loans. So let's dive in. As usual, I've got to share the disclosure. I'm not a licensed attorney, accountant, financial advisor, real estate broker, real estate license, or any other licensed individual. I'm just a student, just like you guys, had a lot of success with these strategies I'm teaching, and I just want to pass that knowledge on to you. This is not intended as specific information or specific advice. This is general educational information. So with that said, let's dive in and talk about some of the differences between lines and loans. So on the line side, lines are daily simple interest. That is interest that is calculated on a daily basis on the average daily balance. We use this to our advantage because, as you saw in Module 2, if we're dumping our whole paycheck into the line of credit, that significantly lowers the overall balance of debt. And immediately we start seeing the effects of that. Because in lines of credit, interest is calculated daily. When we throw that paycheck in, we're being charged interest on that much less principal than in, for example, a loan. So we use the daily simple interest element to our advantage. Now, often lines of credit are interest-only payments. That doesn't really apply to the speed banking strategy because we're using our whole income to offset the principal on those lines of credit. So when you're thinking in terms of minimum payments, a lot of times those are interest-only payments, but we're going to be bypassing that interest as much as we possibly can. There's no way to completely get rid of it, but we're going to be bypassing as much as we can, and we're going to be using a cheaper option by using the speed banking strategy. Also, lines can be used like a debit card or a checking account. A lot of lines of credit have checks, balance transfer checks, even standard checkbooks that are attached to them. I know HELOCs, a lot of HELOC products out there have checkbooks that you can just use it like a checking account. So you don't even need to use your checking account anymore. Your line of credit in speed banking should be used the same way that you use your current checking account. It's where you store your money. It's where you spend your money. So you're going to replace the idea of your debit card and your checkbook with the tools that come with that line of credit. Now, on the other side, with loans, we have an amortized payment structure, which, as you saw in Module 2, that front end loads all of the interest, and then they encourage you to refinance, so you're constantly at the front end of that thing paying mostly interest all the time. In a loan, principal and interest are calculated into each and every payment, but loans are one directional, so you can't actually access the principal pay down unless you refinance that loan, which they want you to do. So it's just kind of a lose-lose situation with a loan. Also, like we said, you cannot use the equity unless you refinance. Now, with lines of credit, the way it works is you have a limit. You're able to use up to that limit. You have a balance that represents the amount of that line that you've already used. You have a minimum payment associated with it, a daily simple interest rate, and it's got a revolving nature. Whereas with loans, you have an origination amount, you have a term, which is the amount of time it's going to take you at your minimum payment to pay it off. Again, you have a minimum amortized payment, which is usually due monthly. And like we talked about, those payments, 100% of that cash flow disappears. The principal portion of that payment only represents equity that you're building. In the case of like a house or real estate, but it's not liquid. You can't tap into it on an as-needed basis. You would have to refinance in order to use that. It has an annual amortized interest rate with amortized payments, and it's one directional, meaning you can pay it and that's it. You can't take money back out. So let's talk about the different types of lines of credit, because there's a lot of lines that we can be using. Credit cards is the most popular one. And that's more often than not, that's what I see people use to start doing the speed banking strategy. You can get unsecured lines of credit. You can get secured lines of credit when it comes to credit cards. So both are available to you. The difference there is an unsecured line of credit only uses your credit score as the security for the line. Whereas a secured line of credit uses some sort of asset, usually with a credit card that's cash. And we've kind of separated those out On the bottom there, you can see we have a cash secured line of credit as well. So you can use cash, you can use other types of securities, assets, those types of things to secure credit card lines of credit. You can use home equity lines of credit. Now, they don't offer unsecured home equity lines of credit because by the nature, it's right in the name. By the nature of a home equity line of credit, you are securing it with your house, just like you do with a mortgage. So it's very similar in that respect, that your house is the collateral. So that's a secured line of credit. Personal lines of credit come in both unsecured and secured. Business lines of credit come in both unsecured as well as secured. And cash secured lines of credit obviously are not, they're not available in unsecured. The nature of it is that it is secured by cash. So that does have collateral associated with it. Now, let's talk about the revolving nature of a line of credit. This is very important when it comes to how and why the speed banking strategy works, is because a line of credit is an account where the principal portion of your payment joins the available credit. So in your monthly payment there, you can see the two lighter blue colors represent a monthly payment. A portion of that is principal and a portion of that is interest. Interest disappears. Interest just goes into the bank's pocket. That's okay. We're never going to get completely away from that as we're talking about debt pay down, and that's okay. What we're trying to do is minimize that as much as possible with this strategy. The reusable principal portion, that's the portion that we're really going to take advantage of, because it allows us to lower our balance by putting our whole paycheck in, reuse the portion that's not taken as interest, and then cause our balance to be lower, which means the next interest payment is going to be even less. So we very much use this nature of a line of credit to our advantage as we're working with the speed banking strategy. So that gives you a good overview of the difference between lines versus loans. We're going to be diving deeper and deeper into this idea in the next modules, but this wraps up module 4. We will see you guys in module 5 when we start talking about understanding interest. See you on the other side.